This is the best of the Retirement Lifestyle Advocates radio program with Dennis Tubbergen.
This is RLA Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. A little bit of a different format as we get ready to close out 2025 and move into 2026. I want to talk to you about some of my forecasts for 2026. So my first big forecast for 2026 is that the devaluation of the U.S. dollar that we've been talking about here on the program all year, I predict that will have to continue. When the Federal Reserve began to increase interest rates in 2022 in response to higher inflation, right here on this program, I observed that this policy would be temporary, and within a relatively short period of time, the Fed would have to reverse course and pursue easy money policies once again. The harsh reality is simply this: if the federal government's budget isn't balanced, the U.S. government will be forced to finance the deficit spending, I should say, by selling treasury bills, notes, and bonds. Now, to state that a different way, the government will have to borrow money to bridge the gap between tax revenues and spending. Now, at the present time, the government is finding enough lenders to finance the current deficit spending and to refinance the debt that is maturing. But that may soon change. In calendar year 2026, the U.S. government will have to refinance $10 trillion in maturing debt on top of financing the ongoing operating deficit. While this level of debt refinancing will be difficult, as the years pass, this debt refinancing task will become even more difficult for the simple reason that more than 80% of the refinanced debt, the debt that's being refinanced now, will have to be refinanced again in 6 months or less. Now, we've talked about this on the program, but just for an example, at the most recent U.S. government bond auction, the U.S. debt sold $602 billion in debt, but most all of it, as I just said, was short term. 14% of that $602 billion will have to be refinanced again in just 4 weeks. 13% will require refinancing in 6 weeks, 13.5% in 8 weeks, about 15% in 13 weeks, 12% in 17 weeks, and 13.5% in 26 weeks. That's more than 80% of the maturing debt that will have to be refinanced again in 6 months or less. The borrowing habits of the U.S. government are now resembling those of a payday loan customer. Now, to be fair, part of the reason that lenders are reluctant to loan the U.S. government operating capital for the longer term is a warranted skepticism of the creditworthiness of the U.S. government over the longer term. That's a legitimate concern. There are deficits of $2 trillion a year or more for as far as the eye can see. However, it tells you potentially one other thing that I'll talk about in this segment as well. It tells you that many of these debt investors are expecting that interest rates may move higher. Now, interest rates demanded by lenders are commensurate with the creditworthiness of the borrower. The less creditworthy the borrower, the more interest that a lender is going to demand. So as the financing of U.S. government debt becomes more difficult and more challenging, the Fed will ultimately have to step in, as they have previously, and become the lender of last resort to the U.S. government. Now, the key point is this: the Fed creates the currency or credit to buy government debt when required to do so. currency creation or quantitative easing devalues the currency. Now, if you happen to think that the Fed won't create more currency to become the buyer of last resort of U.S. government debt, you have to consider the only alternative to this at some point down the road is an outright default on outstanding debt. An outright default would have the U.S. government telling creditors that they weren't going to get paid. That's simply not going to happen. So we have to assume that devaluation will continue. And an important thing to keep in mind as we move into 2026 is to have assets in your portfolio that cannot be printed. Now, let me talk a little bit about interest rates going up, because many of you listening to this are probably saying, well, Dennis, wait a minute. Isn't the Fed cutting rates? Yes, they are. In fact, the Fed has initiated rate cuts since September of 2024, reducing the Fed funds rate by 1.5%. Now, if you're not familiar with the Fed funds rate, it's the interest rate that financial institutions charge each other for overnight loans. There is a common misconception about the Fed funds rate. Many believe that when the Federal Reserve drops interest rates, consumers borrowing money pay a lower interest rate on loans. While this has been true historically, this is simply not the case now. The Federal Reserve began cutting interest rates in the most recent cycle, as I just said, in September of 2024. At that time, the average interest rate charge on a 30-year mortgage was 6.09%. Presently, the average interest rate on a 30-year mortgage is 6.21%. As the Fed has reduced the Fed funds rate, the interest rate paid by consumers has risen. That's because, as I said earlier in this segment, lenders charge an interest rate that is commensurate with the risk of making the loan. The reality is that consumers are up to their proverbial neck in debt. The Federal Reserve publishes this data. They look at housing debt, they look at non-housing debt, but when you tie it all together and just look at consumer debt, from the first quarter of 2004, about 20 years ago, household debt has increased by about 125%. And that explains why, according to a recent study conducted by the Federal Reserve, and this data was published actually by Charles Schwab, 25% of all consumer credit apps are now being declined. 1 in 4 consumers applying for credit are not getting it. Credit is tightening. Banks are pulling back. U.S. bankruptcies have now reached the highest level since COVID. So despite the actions of the Federal Reserve, it's my belief that interest rates will continue to rise. Now, I will be back after this short break to continue giving you my forecast for 2026. Don't go away. Dennis Tubbergen here, host of RLA Radio. And I'd like to invite you to get my 2026 forecast for the economy and the investing environment. All you need to do to get your free copy of the report is visit requestyourreport.com. When you visit requestyourreport.com, all you'll need to do is enter your name and address, and I'll be glad to send you a complimentary copy of my 2026 investing and economic outlook. What will happen to the U.S. dollar? What's the forecast for gold and silver? Where will stocks go? What does 2026 hold for the real estate market? I cover all that in the 2026 forecast report. All you need to do, again, to get your free copy is visit requestyourreport.com. The website again, requestyourreport.com.
You're listening to the best of the Retirement Lifestyle Advocates radio program with Dennis Tubbergen.
Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. We are talking about my forecast for 2026 in the economy and in the investing markets. Glad you're listening in today. Hey, there's no secret, as we've talked about here on the program over the course of 2025, that there are two economies in the United States. The first, in which the affluent reside, seems to be doing very well. In fact, according to Moody's Analytics, the top 10% of income earners now account for half of consumer spending. That is an historic high. The affluent, who have assets, have been more insulated from the inflation that has adversely affected middle income and lower income Americans due to the fact that the affluent own assets like stocks and real estate and precious metals. And these assets have increased in value, or at least nominal value, with inflation, precious metals in particular. Now, the second economy is the economy in which lower income and middle income Americans reside. Consumer prices, according to the official inflation rate, and the official inflation rate is measured by the Consumer Price Index, as we've discussed in the past. This is a bit of an arbitrary inflation measure with adjustments being made. But taking the official rate of inflation, consumer prices have increased by about 23% since 2020. Now, the official inflation rate, as I said, is not really close to the real inflation rate. If you go to the chapwooడింdex.com, the Chapwood Index measures the price of certain consumer items by going out and looking at what these items cost in various metropolitan areas every 6 months. Now, if you go to the Chapwood Index, you'll see that consumer prices have been increasing over the past 5 years at an annual rate of 10 to 13%, depending on the region of the country in which you live. So if we use the low end of the Chapwood Index, consumer prices have increased significantly more than 23%. Real costs, according to the Chapwood Index, since 2020 have increased by about 60% on average. And that 60% increase is confirmed when you take a look at real costs. Let me just give you one example. The base cost of a Chevy Silverado pickup in 2020 was $28,500. In 2024, the base cost of a Chevy Silverado pickup, $44,495. That's an increase of 56%, right in line with what the Chapwood Index says consumer prices have done. Now, I believe that this bifurcation of the U.S. economy is going to continue because the Federal Reserve, as I talked about in segment 1 of today's program, is once again pursuing easy money policies. Now, these policies will ultimately make the eventual economic outcome more painful, in my view. Now, as I wrote about in my new retirement rules book, historically speaking, there is an economic cycle that it's really undeniable that this cycle has existed. In the book, I offer many examples of this cycle going all the way back to the Roman Empire. Now, a full discussion of this cycle goes beyond the scope of today's program, but let me just give you a brief overview for context. Now, this cycle repeats itself and is predictable because the collective behavior of politicians is predictable. Politicians overpromise, and then to fund those promises, they overspend. This has happened all the way back to the Roman Empire. Eventually, these politicians and their appointed policymakers resort to currency creation to fund the budget deficits. Currency creation originally took the form of debasing coins by reducing the precious metal content of the coins. This is what happened in the Roman Empire when the denarius was the currency. The denarius was almost pure silver. However, over time, the silver was replaced with worthless alloys, and the denarius ultimately became a fiat currency. Now, once paper currency was in use, currency creation took the form of reducing the backing of the paper currency by precious metal. Then, once currencies became fiat currencies, as all currencies around the world today are, currency creation was much easier. Currency could be printed or digitally created. Now, no matter what the form of currency creation, the cycle is the same. Currency creation is followed initially by a prosperity illusion, which is followed by inflation, which is followed by deflation or hyperinflation, depending on the decisions made by politicians and policymakers. If currency creation stops, deflation becomes the dominant economic force as debt is purged from the system. On the other hand, if currency creation continues, deflation occurs in real terms when you price assets in gold. I'll talk more about that in the last segment of today's program. But inflation or hyperinflation is the economic trend in nominal terms. It now seems that we may see this latter outcome. As I just noted, the Fed is now once again pursuing easy money policies that will likely fuel price inflation, but in real terms, we will see deflation. And I'll talk more about that in the next segment right after this break. Don't go away. Dennis Tubbergen here, host of RLA Radio. And I'd like to invite you to get my 2026 forecast for the economy and the investing environment. All you need to do to get your free copy of the report is visit requestyourreport.com. When you visit requestyourreport.com, all you'll need to do is enter your name and address, and I'll be glad to send you a complimentary copy of my 2026 investing and economic outlook. What will happen to the U.S. dollar? What's the forecast for gold and silver? Where will stocks go? What does 2026 hold for the real estate market? I cover all that in the 2026 forecast report. All you need to do, again, to get your free copy is visit requestyourreport.com. The website again, requestyourreport.com.
You're listening to the best of the Retirement Lifestyle Advocates radio program with Dennis Tubbergen.
Welcome back to the last segment of RLA Radio. I am your host, Dennis Tubbergen. Hey, when we were talking at the end of the last segment, I was explaining that there are one of two potential economic outcomes we see here because of this predictable cycle. Number one, we can see deflation. Deflation is the outcome that we will see if currency creation stops. On the other hand, we could see high inflation or even hyperinflation if currency creation continues. And that seems to be the case. Now, even if we see high inflation nominally, in real terms, we'll see deflation. Now, what do I mean by that? Well, for most of history, gold has been money. So if we price certain assets in gold, we see that deflation has really already kicked in. We're already seeing it. Let's just take a look at stocks. At the beginning of calendar year 2020, the S&P 500 stood at about 2750. At that time, an ounce of gold sold for about $500 per ounce. So to take the devaluation of the US dollar out of the equation, we take the 2750 S&P 500 value and divide by the $500 per ounce, which was the spot price of gold. So if I take 2750 and divide by 500, that gets me the S&P 500 priced in gold, and I get about 5.5 ounces of gold. In other words, It took about 5.5 ounces of gold to buy the S&P 500. Now, as we are moving into 2026, as 2025 is drawing to a close, the S&P 500 is at about 6,800, and the price of gold per ounce is just a little lower than 4,400. Let's do the same math. 6,800 divided by 4,400, and we see we can now buy the S&P 500 for about 1.5 ounces of gold. So 25 years ago, it took 5.5 ounces of gold to buy the S&P 500. It took 5.5 ounces of real money to buy the S&P 500. Now it takes 1.5 ounces. That tells you that in real terms, we see stocks priced lower. Stocks are priced higher because the metric, the US dollar, has been devalued. Easy money policies always produce the same outcome, and we are now headed down that road. And I believe we'll see even more deflation in real terms, and we'll see more inflation in nominal terms. In fact, I would make the argument that we are going to move into an even more intense stagflationary environment. Now, what is stagflation? Well, stagflation is defined as an economic contraction or recession that's accompanied with inflation. Now, I believe that the US dollar will continue to be devalued. The only other choices are to balance the budget or default on the debt. I don't see either of those things happening, and you certainly are free to disagree. Now, we are now seeing signs that the US economy is slowing. In fact, the majority of Americans believe that we will see a recession. A recent survey conducted by Harris Polling found the majority of Americans believe that a recession is coming. 64% of Americans surveyed believe the economy would enter a recession in the next 12 months. Now, what's really interesting when you break down this survey is that when you look at the personal finances of the survey respondents and see how they responded, it further confirms this bifurcation of the economy, that we have two economies that I talked about in a prior segment. Of those poll respondents living paycheck to paycheck, 75% felt that there would be a recession in the next 12 months. Of Americans who are not living paycheck to paycheck, only 54% felt that a recession was imminent. Now, a recession is typically defined as 2 consecutive quarters of economic contraction, which we have not seen in nominal terms. But let's go back and price economic output in gold, taking US GDP in dollars and then converting that to what is the output of the economy in gold. Well, when you do that, in 2020, US GDP was about 11 billion ounces of gold. It increased to 13 billion ounces of gold in 2021 and to 14.4 billion ounces of gold in 2022. In 2023, it declined to 13.7 ounces, and 2024 GDP price in gold once again fell to 11.25 billion ounces of gold. So from 2020 to the present, priced in gold, we have seen economic contraction. So when you adjust for devaluation, it's reasonable to say the recession may already be here. And the jobs report seems to confirm that we may be headed in that direction. In 2025, U.S.-based employers have cut nearly 1.2 million jobs. That's 54% higher than the first 11 months of last year. Again, as I close today, I'd like to invite you to get my 2026 forecast issue. I've given you a preview of it today, but go ahead and go to requestyourreport.com. I'll be glad to send you the entire report absolutely free. Have a great holiday season.